Greetings, class. This is Chapter 8, Current Liabilities. I'll do a couple of short tutorials on some of the different topics. This first one is on short-term notes payable, where we have a company on December 31st that has actually borrowed some money to purchase equipment. The note matures in 3 months, which makes it short-term because it's less than 12 months. And it carries an interest rate of 9%, and then both the principal and interest are due at maturity, which means when we do our financial statements at 12/31, which is 1 month from the date that we borrow the money and purchase the equipment, we will have to recognize the interest that is due to the lender at that point in time when we do the financial statements for our adjusting entry. We'll use this formula again as far as to calculate the actual interest expense. The interest is face value, which is the $30,000, that's how much we borrowed, times the annual interest rate, which is 9%, times a fraction of year. So the first part of this till we get to the financial statements, do the adjusting entry as 1 month, and then we have 2 more months until the actual note matures. So let's look at what it looks like for journal entries. So the first one, the journal entry, when we actually purchase the equipment, we will debit the equipment account for the $30,000, and then we have a short-term ST, short-term note payable, also that's due for $30,000. So for the next entry that we have to record, we're looking at the adjusting entry that will happen at year end for the financial statements, and for that one we will actually have to use this formula to calculate the interest expense, which is right here. So the $30,000 face value of the loan times the annualized interest rate, so it's got to be 0.09 because it is a percentage, times 1 month over 12 gives us $225 as far as the interest expense that we need to recognize at year end. So on 12/31/13 we would recognize the interest expense based on the matching principal to show the amount that we owe, recognize it in the financial statements, but since we're actually not paying it, we put it to the interest payable account, which is our current liability. So then that is the adjusting entry. Then we have one more entry to take a look at. When the note actually matures, we will pay both the interest and principal at maturity. So we'll have to clear out this interest payable because we did not pay it at year end. So as of the, I think it's 3/1, when we actually do the final calculations on this, when we do it on 3/1, we'll have to pay off this amount that we accrued and any additional interest for the next 2 months because we only picked up 1 month's worth of interest. So let's look at that. So let's look at the calculation first. So the $30,000, again, is the face value. Interest rate does not change, 9%. And then we're picking up the final 2 months. So our interest expense for that period, for those 2 months that we recognize on 3/1, because that's the maturity date, is the $450. So first thing we do is we go ahead and close out the amount that we didn't pay before, the $225. Then we can close out the note payable as far as what we owed. We'll go ahead and pay that off. Then last but not least, we'll pick up the actual interest expense for those final 2 months, which causes us to outlay the total of this because we owed that interest for December. We owed the full principal for the note of $30,000, and then the current 2 months from January to February to March 1st, interest expense is $450, so our cash outlay is $30,675. These are the journal entries, so we record these when we actually post to the general ledger T accounts. This is what it would look like. So this is the cleaned up version of the journal entries, the same thing that we did, same account, same amounts. And then this is the second journal entry as far as at maturity, where we actually pay off the note plus all of the interest that we expensed and accrued. So this is the end of this tutorial for Chapter 8 on short-term notes payable.